This is being recorded for the Absolute Alerts Discord. The link is in the bio. So feel free to join our Discord. Feel free to subscribe and like the video. We are constantly giving call-outs and we're always looking for new people to make money with us. Reading candlesticks is one of the most essential and crucial parts of trading. If you do not know how to read candlesticks properly, then you're not going to be able to make it as a trader, pretty much. This actually goes for every single person that trades with us at Absolute Alerts. And again, I'll say, if you're not a member of Absolute Alerts yet, there's a link to join inside of the YouTube channel's description. There's also a link to join our Discord in the description of the video. You know, feel free to stop by and make some money with us. But if you do not know how to read candles, then I could almost guarantee that you will not be able to be profitable, because I could trade stocks without doing any fundamental or social analysis or even technical analysis, but just by looking at candlesticks. I'm gonna use Weibo. All right, so this candlesticks, you know, I think they first came out with them about on the actual stocks about 80 years ago or so. Let me start off by explaining the basics of a candlestick. A candlestick, for example, on this chart right here, is a 1 minute chart. So each one of these candlesticks represents the price action for 1 minute. If I switch it to 5 minutes, each one of these candlesticks represents 5 minutes of prices. So let's take a look at how we read them. I'm going to stick to the 5 minute one because for now, I just feel like it's going to be easier. The part right here, like this is the perfect candle actually for this example. This at the top was the high price. The bottom of the candlestick was the low price within that 5 minute period. So on this candlestick, within that 5 minute period, the price jumped for Amazon from $3,649.37 to $3,657.41. That's top and bottom of the candlestick. And in the middle is basically where you are settled at the end of that time frame. These little thin lines up here, they're called wicks. And what wicks are little miniature spikes where that's where the price tipped off at. Like this was the very, very top, but it didn't actually get there. It's like, you know, sometimes you see a price of a stock go from, you know, usually I say it's $6.20, $6.25, but then you see it suddenly spike to $6.40 and then back down to $6.20. That's where these wicks come from. That's how they're generated pretty much. Now the top wick on here is the top price. The bottom wick is the lowest price within that time frame. Obviously, I don't think I have to explain that the red candlesticks means the price went down. The green candlesticks means the price went up. That's pretty much self-explanatory. But how would you use that in trading? So that's where reading charts and chart formations comes into play. I'm sure you guys have heard, you know, the cup handle formation several times in a row already. You know, people see these things, higher highs, higher lows. That is all read through candlesticks. There's no indicators like you see on my Weibo account. I really don't use many indicators. I still have my MACD, I still have my RSI, and I have my moving average right here. But that's all I need. The rest I could just do by candlesticks. Why? Because I could see over here. For example, I see the decline over here. I'm not going to buy here or here or here or even here. Why? Because this is not a confirmation. This does not mean that the price is going back up. A real confirmation is when you get, in my preference, at least 3 green full candles in a row. And if you were to use my method where I say always go for 3 full candles in a row, and what I mean by full candles is this is not a full candle. This right here is a full candle. But over here, you didn't get 3 full candles in a row. So say you bought here, you would have dipped right back down. Now, 3 full candles in a row would be 1, 2, 3. I mean, it's technically still not full because of this one, but this is still a good buy indicator. Why? The chart explains itself. I'm going to answer this question real quick because it just threw me off. Which time frame for 3 candle indicators? It doesn't really matter. Like I said earlier, it all depends on what you're doing. If you're day trading, swing trading, on what kind of time frame you should be looking at. For example, if you are day trading and your time frame is 1 hour, I'm probably going to laugh at you. Why? Because you're going to get an update on the price once an hour. That's it. You will literally see 1 new candle form per hour. As you can see down here, it's 21, 22, 23, 24. If you want to be actually day trading or swing trading, I always use the 1 day, 1 minute. Over here, range 1 day. Now you got your chart set up. Now each one of these candlesticks, it represents 1 minute out of the day. As you can see over there on the bottom, it says 15:55. I move over to the next one, 15:54. If you want to go for more of like a relaxed play, then you could always set it to 5 minutes, which I think most people prefer. I prefer mine in 1 minute, but a lot of people do prefer the 5-minute charts. So you set the range, 1 day, interval, 5 minutes. Now, each candlestick is going to represent 5 minutes of the day. Let me just switch this over from Amazon though to a different stock, SPCE. Now, this is 1 day, 1 minute for SPCE. Each candlestick represents 1 minute. If you were to buy it over here at 13:33, so that's 1:33 p.m., you could have sold for $30 at 2:35. But instead of having to track it minute by minute, and by the way, before I move on to the 5-minute candlesticks, I do want to point out again why I always tell you guys to use the RSI and MACD. As you can see over here, the low point corresponds directly with the RSI and the MACD sell-off. The high point over here corresponds again right down here with the high point of the RSI and the MACD volumes. Now on Weibo, you guys will have these 2 moving averages. These are your moving averages for the MACD. You could remove them, you could not. I personally usually remove mine, but I'm not going to give you guys my opinions on it. It's up to you. If you find it helpful, then keep them. If you don't need them, then you could get rid of them. But I always rely on the RSI and the MACD on trying to figure out where is the perfect entry. For example, if you were to get an alert from me or Athletic or anybody else, I don't care what server you're on, and we said, this stock looks like it's a good stock, I'm going to add a position. But the stock is not parabolic. The first thing you should do is you should open up your charts. You should look at the candlestick formation. If it's dipping, don't just buy. Buy when the dip is done. So how do you do that? You look at the candlesticks, you read them, you wait for that confirmation where you see that it's starting to go back up. Now, obviously, you guys aren't, professionals when it comes to reading candlesticks yet, which is why you use the RSI and MACD to help you. So you see over here that it's, pretty much at its lowest. You see the RSI is pretty much at its lowest. And you see the MACD, the sell-off is pretty much done. See where it starts going green on the MACD over here? That's when the RSI starts rising. That's when the candlesticks start rising. So now you know that, okay, this is the low point of this stock. This is the low point of the price. This is a good time for me to be able to buy in, because I know that from here, unless it's going to break support, I'm not losing money. And what I mean by break support is right down here. You see over here, it broke support. This bottom line is the support for the RSI. It broke it, but then it went back above it. However, if you were to purchase here and you were to sell here, you would have made a profit. If you were to, I don't know why the RSI keeps disappearing on me, but if you were to purchase here and sell here, you would have made a profit. So that's why I always say, don't just blindly buy into a stock when you get an alert. There you go, my RSI is back. It's like there's a ghost in my computer. So, always when you get an alert, the first thing you should do is first you pull up your chart. You take a look at where the price is heading. If we tell you add when it breaks a certain price point, then yeah, you don't have to really pay much attention to those indicators, because we know what we're talking about. And what that's called is a momentum play. We know that once it breaks resistance, it's going to set a new resistance. And the resistance that it just broke is going to become its support. So if I say, A, B, C, $3.20 break adds, basically what you're doing by adding at $3.20 is you're buying that stock at its new support level. Why? Because by breaking that resistance now becomes its new support, and it sets itself a new resistance. That's why we do call outs the way we do. That's why we say when it breaks this point, then you could add. Because by breaking the resistance, that resistance becomes now the support. So, and you could even take a look over here. Over here, this was the resistance. So say I said 29.58 breaks add, you would have added over here. And now 29.58, as you can see, is the new support. So let's see, 29.58. There you go. As you can see, for the entire day now, it stayed about above 29.58. Why? Because once it broke this 29.58 part, the 29.58 became the support, and the new resistance became $30.04. That's called a momentum play. So now you guys understand how to, play around with candlesticks. You understand how they work, what they represent. Each candlestick represents that, time frame that you select for it. You guys understand what wicks are. So don't, just because you see a wick doesn't mean that it's something terrible or terrifying. Oh, there you go. I finally figured out how to zoom in. See, these are the wicks over here. These are full candles. These are not full candles. This is basically the best way to describe a candlestick that looks like this is there was a fight. There was a fight between bulls and bears. Because it's green, bulls won, but barely by any. And you could see it here also. There was a fight over here. The Bears won, but not by much. However, you're able to see that over here the Bulls were winning. Then over here, you could see by the wick. This is why wicks are important. You could tell because the wick went down so low at one point that at one point there was so much pressure to sell that it actually, the wick of this candle fell below the lowest price of this green candle. So that's a clear dead giveaway that right now there's a lot of selling pressure. And what happens next? Guess what? Boom, it goes back down again. And you could see that now the Bears are taking control. Over here, Bulls, they tried to stay ahead, but they could not make any momentum. That's why you barely see any kind of action over here. Over here, Bears again, they have more momentum. And that's when the downtrend starts. Now, down here, you can see you got more buying volume down here. You could see by the MACD that you're starting to, the sell-off is pretty much starting to run its course. It's ran its course and it's starting to get less and less. And as the green begins, that's when the purchasing begins. And it also correlates with the RSI. But like I said, always watch your candles because the candle could be the giveaway before the indicator. The indicator is never going to save you. If you see a candle like this, right after this, you have to ask yourself, why did this wick go down so far? And, what am I expecting next? Because this is a 5 minute, this is a 1 minute chart, but if this was a 5 minute chart, it would take 5 minutes for this candle to be complete. On a 1 minute chart, it takes 1 minute for it to be complete, but you have to see, you're going to see that the candle is red, but it's moving downwards. It's moving downwards. But this right here was a clear giveaway by that wick that a sell-off is coming. Something happened where it put a lot of pressure, and that's when the sell-off began. And same over here, with this one, you could see that over here, it dropped, but then the next green candle was already higher than the sell-off, the red candle. The wick went higher. This one, even though it's a bearish candle, it's still higher than the previous low. So even though there was more selling here, the price point still moved up. And that's when you get your next green over here, you have a sell-off. And like I said, all stocks come and go in waves. And so you can see it's always going to be wavy. It's never going to be just one straight line up. So that's the way you have to interpret candles. And the reason why I wanted to include this part on looking at candlesticks, looking at indicators, and knowing how candlesticks work, what these little thin lines are, why can't I sell at 29.84, but instead it sold for 29.78? This was just a temporary spike up in buying volume. That's it. But the main candle is the full part. The top part is the highest. The bottom part is the lowest. For red candles, you know that this is the lowest price it hit. For green candles over here, this is the lowest price it hit. This is the highest price it hit. But judging by this, judging by the wicks, you are able to tell like how that battle is going between bulls and bears. Also, you have your RSI to help you, and you have your MACD to help you. Combine all three of those, and like I said, when you get a call out, don't ask, what do I buy in or where do I sell? Pull up your chart, Say we told you to buy in over here. Instead of saying, where am I going to sell now? Pull up your chart, take a look at the candlesticks. When you start seeing things like this, you start seeing a sell-off coming. You start seeing the RSI starts dropping. You start seeing that MACD starts going red. That's your clear sign. Get out with your profits now. Don't hold unless you want to lose money. Because if you want to keep your money, then you're going to sell. If you want to, take a risk of, going through the red process and holding on to it, and then praying that the price tag goes back up, then yeah, you do have that choice. But do not message us later and ask us, well, why am I losing money? Because we cannot read all your charts for you. We give you the alerts, but from there, that's why we do these Zoom sessions. We want you to be able to understand how to read these charts and how to see when that sell-off is going to come. And it's really not that hard if you actually look at it. Every time like this, you don't have to be worried. Like I said, higher highs, higher lows. Like this low is lower than this low, and that's lower than this low. This low, even though it's a little, dip off, it's nothing to panic about. Why? Because look, the RSI is showing you it's still moving back up, and then you still got higher highs. But over here, you see a steep drop in RSI. You see the MACD is showing you that there's a sell-off beginning, and you see that over here now, 2 times in a row, and the bulls barely won, but the bears clearly won. So what does that mean? That means right now there's more selling pressure than there is buying pressure. You have to interpret these candlesticks for what they really are. It's all I guess it's like a scale of, supply and demand, who's buying and who's selling. First one, how do you predict that a stock is going to break the price point? We really can't predict that a stock will break the price point. We hope it does, but I could make guesses. I could make assumptions. For example, I could look at level 2 over here. And by looking at level 2, I see that there's one order to sell 100. And by the way, this is not 100 shares. This is about 1,000, because for every one on level 2 is 100 shares. But then over here, I see that the demand is much higher. So I could naturally assume that the price is going to go up next. Now, it doesn't always work that way, of course, but you have a good chance. Also, if we told you to buy in here at 29.53, and we're saying 29.81 breaks at, then we're assuming that once it sets that new support, it's gonna go up higher based on momentum. And we're not just throwing these numbers out just by candlesticks. We're taking a look at volume. Aside from volume, we're taking a look at relative volume, because I explained in another video, you have the volume and then you have your relative volume. The difference between those two is, when it comes to regular volume, that's just, your regular trading activity. Relative volume is the increase in trading activity for that specific time or that specific day. So if your normal volume is 20 million, and suddenly today you're trading at 50 million, something's happening. Either you got a lot of people selling or you got a lot of people buying. Usually it's both. And at the end of the day, it comes down to one thing. It's a battle of bulls versus bears. Do you use pivots and take on Heikin-Ashi candlesticks? They say it hides the noise. Yeah, I use Heikin-Ashi. I definitely recommend everybody to use Heikin-Ashi. It is much better, but I do not use pivots. Like, I'm the kind of person where I like a minimalist setup. Like, as you could see over here, this is my Weibo setup: RSI, MACD, Heikin-Ashi candles. That's it, moving average. Also, same thing applies for my TD Ameritrade. Let's see. My charts, they're same thing. RSI, MACD, my moving average, and Keltner channels. That's it. I don't go into all those, I could sit here and lecture you for another 3 hours on Bollinger Bands and this and that, but I don't think that it's actually going to help you to be a better trader, because all you're going to do is you're going to give yourself a messy chart. You're not going to be able to read the indicators properly. And it takes time to just get used to it. Honestly, the more simple your chart is, the more chances there are of you being correct. Why don't I use VWAP? Some people like to use VWAP, the VWAP indicator. I personally don't. I was never a fan of it. Since a lot of your alerts are momentum based, and you find VWAP not helpful, it's not that I don't find it helpful. It's just that I prefer relying on MACD and relative volume. VWAP, yeah, it's volume. It's basically a volume weighted indicator, but it also, it's like a crutch, I guess you could say, in my opinion. I don't want to have a crutch. I want to be able to read volumes myself. I want to be able to look at relative volume increases myself. I don't want somebody telling me, because those indicators, they're not actually reading current data at the moment and showing it to you live. What they're doing is they're taking the data and comparing it to the past. So if there's a huge volume spike, your VWAP, it's not going to pick it up right away. Yeah, I mean, yeah, you see a little spike and on the indicator, but you won't actually know like what's actually happening. What's the actual volume spike? Why did it spike? What's the amount? Is it more selling? Is it more buying? It helps, but it doesn't get the job done all the way. Indicators, the way they work is they analyze the past to give you a sense of the future. Thanks everybody for watching. More videos to come. We usually do them once a week, and I will see you later.